without working with us or giving us a chance in any way, they auctioned the second mortgage. A gentleman ended up purchasing it and showing up on our doorstep on a Saturday to tell us that he had purchased our home and that we needed to vacate.
Before a homeowner even comprehends that a private equity firm has acquired their dormant debt, their property deed is quietly transferred to a speculative cash buyer on the courthouse steps, permanently liquidating decades of hard-earned middle-class equity without a single day in court. Ultimately, that was when they arrived there.
At some point, we just we fought and we fought and we fought. And then we just kind of threw up our hands.
The majority of people in the United States build their wealth and their financial future with the equity of their home. And these zombie mortgages are robbing people of the equity.
A lot of times they're able to get 10, 20, even 30 or 40 times their initial investment. This is a hugely profitable business.
A key thing in a lot of these cases is if a borrower wasn't getting statements for many years, they may not owe back interest for that time period.
We thought it was an American dream, but it's become quite the American nightmare.
A zombie mortgage is a loan that was taken out before 2008, and then often a decade or so later, after not hearing about that loan for years, a debt collection firm buys it and asks the homeowner to pay back not just the money they took out 10, 15 years earlier, but all the back interest.
The CFPB has returned over $21 billion to more than 205 million Americans who were cheated by big banks and giant corporations.
Imagine answering a knock at your door on a Saturday morning only to find a stranger on your porch claiming they just bought your house. You've never missed a payment on your primary mortgage. You weathered the 2008 housing crash and spent the last 15 years diligently building equity. But the person on your porch is handing you an imminent foreclosure notice, demanding hundreds of thousands of dollars for a debt you didn't even know you had. A specific legal loophole currently exposes hundreds of thousands of Americans to sudden home loss, all perfectly sanctioned by existing property loss. These are called zombie mortgages. They are legally dead debts from the 2000s that private equity firms have intentionally resurrected. These firms aim to liquidate billions in home equity by foreclosing on debts that owners believed were settled over a decade ago. Without realizing it, middle-class homeowners have spent the last decade acting as unpaid property managers for Wall Street investors. To understand how this trap actually works, we have to rewind to the peak of the mid-2000s housing bubble. The mortgage industry was heavily fueled by predatory practices designed to generate massive loan volume. This diagram illustrates the most pervasive tool of the era, the 80-20 piggyback loan. It allowed buyers to completely bypass traditional down payments. The primary mortgage covered 80% of the purchase price, while a secondary loan covered the remaining 20%. These secondary loans carried predatory terms featuring adjustable rates skyrocketing past 9% and balloon payments designed to fail. When the market inevitably collapsed in 2008, property values across the country plummeted. Millions of Americans were left completely underwater, owing significantly more on these combined loans than their properties were actually worth. That severe negative equity environment set the foundational stage required for the modern zombie mortgage crisis to occur. Because the holders of those secondary mortgages were in a subordinate lien position, they knew they would receive nothing in a foreclosure sale until the primary mortgage was paid off. Many original lenders simply stopped trying to collect. The monthly statements stopped arriving in the mail. In many cases, borrowers instead received an IRS 1099-C form, a federal tax document that officially denotes a cancellation of debt. Homeowners paid taxes on that forgiven debt and spent the next decade rebuilding their lives, operating under the assumption that the secondary loan was permanently forgiven. But they missed a critical hidden detail. While the collection calls stopped, the actual physical liens tied to those second mortgages were never legally removed from the property's title records. The quiet period abruptly ended when a specialized breed of private equity firms entered the secondary mortgage market. They began scanning title records hunting for dormant liens, and they acquired them for pennies on the dollar. A private equity firm could purchase the rights to a forgotten $100,000 second mortgage for as little as $2,000. Once acquired, the new owners weaponized information asymmetry. They intentionally sent no monthly statements, issued no default notices, and avoided contacting the homeowner entirely. This silence allowed an invisible meter of compounding interest and late fees to run continuously against the property for over a decade, while the homeowner remained completely oblivious. This chart plots national home equity values from 2008 to 2020. The pandemic-era housing boom drove property values past their pre-2008 peaks. This sudden surge in value meant that secondary mortgages, which were functionally worthless a decade ago, were now secured by significant equity. Wall Street took notice. Because they had allowed back interest to compound silently for 15 years, a $98,000 original piggyback loan had mathematically ballooned into a $200,000 or even $300,000 demand. By purchasing a lien for $2,000 and forcing a massive settlement, these investment firms generate a 3,000 to 1,000% return on investment, extracted directly from the homeowner's hard-earned equity. When the private equity firm finally decides to strike, the execution is brutal and psychologically devastating. Without any prior warning, the homeowner receives a legal notice of default and an imminent threat of foreclosure. This system relies on a calculated extraction of middle-class wealth, utilizing a deliberate 15-year silence to maximize the final payoff. If you or someone you know utilized an $80.20 piggyback loan prior to 2008 and assumed the secondary debt vanished after receiving a tax form, you must take immediate action. Homeowners must proactively verify their property titles and check for lingering liens today. In a financial system designed to intentionally monetize information asymmetry, the ultimate and only defense you have is your own awareness. Imagine waking up to a foreclosure notice for a decade-old debt you thought was legally dead and buried. In an instant, hundreds of thousands of dollars in hard-earned home equity are on the line. This flowchart illustrates how this highly coordinated wealth extraction machine actually operates. Private equity firms are specifically targeting old 80-20 piggyback loans to siphon equity directly out of middle-class households and aggregate it into massive institutional portfolios. When a family loses $150,000 to one of these silent debt collectors, that money is permanently erased from their future and their local consumer economy. Instead, it gets funneled straight into the offshore accounts and dividend payouts of private equity partners. You might assume the federal government heavily polices this predatory behavior. The bitter irony is that the Consumer Financial Protection Bureau was established in 2010 to stop the lending practices that caused the 2008 financial crisis. Yet for years, the agency operated in a state of near-total paralysis regarding this specific loophole. It wasn't until April 2023 that the CFPB finally issued an official advisory opinion. In that opinion, they warned that under the Fair Debt Collection Practices Act, it is strictly illegal for debt collectors to sue or threaten to foreclose on mortgages past the statute of limitations. The problem is, this opinion acts as a mere warning, not a lethal deterrent. Without aggressive enforcement and severe financial penalties, Wall Street firms view an occasional legal setback as nothing more than the cost of doing business. This vast regulatory vacuum is exactly what these debt buyers rely on. The sheer lack of federal intervention provides the operational runway they need to execute their extraction strategy on a national scale. Because the federal response is heavily muted, the defense against zombie mortgages has fractured into a chaotic state-by-state legislative battle. It is a desperate game of regulatory whack-a-mole. Some states are attempting to push back. Virginia introduced laws requiring creditors to swear under penalty of perjury that they have actively been sending monthly statements and attempting to collect the debt before they can even initiate a foreclosure. The rule is clear. If a financial firm sat silently for a decade just to let the interest compound in the background, they completely forfeit the legal right to seize the property. While these localized victories protect some homeowners, relying entirely on a patchwork of state legislation creates a dangerous systemic vulnerability for the rest of the country. This map of the United States illustrates the concept of geographic arbitrage. Wall Street debt buyers understand these state borders perfectly, and they weaponize them. If they face legal friction in a highly protected state, they simply pivot. They redirect their data architecture and capital to aggressively target homeowners in states with weaker consumer protection laws, like Ohio and Florida. It creates an absurd legal environment where an American citizen's basic property rights are completely dictated by their zip code. Until there is a unified, ironclad federal statute banning the collection of uncommunicated, time-barred secondary mortgages, millions of properties remain legally exposed on the open market. The harsh reality of the modern economy is that you cannot rely on regulatory agencies or basic fairness. You are the only one who will truly defend your personal financial ledger. If you purchased a home prior to 2008 and utilized any form of secondary financing or a piggyback loan, you must take proactive steps. Contact your county recorder's office and pull a full title report to check for any outstanding unresolved secondary liens. Never assume that a 1099-C cancellation of debt form provides absolute legal immunity. It handles the tax implications, but predatory buyers will still attempt to enforce the underlying property lien. If you discover a zombie mortgage, or if a terrifying notice of default arrives in the mail, do not panic. Absolutely do not sign a loan modification and never acknowledge the debt over the phone. Acknowledging the debt over the phone is a fatal trap. It can legally reset the statute of limitations, giving that dead mortgage new life, and handing the debt buyer the exact leverage they need to foreclose. Instead of attempting to negotiate with these firms yourself, immediately retain a specialized foreclosure defense attorney. Your attorney will launch a counterattack by demanding the exact legal documentation required to take your home. First, they will force the debt buyer to produce the original promissory note. Second, they will demand a complete, itemized payment history proving the firm legally sent you monthly statements over the past decade. If the firm sat in silence, their legal standing shatters. Wall Street is counting on your fear, your silence, and your financial ignorance. By aggressively auditing your own records and understanding your legal leverage, you can protect your equity, secure your family's future, and defeat the zombie mortgage threat.